Hello, my name is Brian Overby. I'm also known as the Options Guy, and I am the author of the Options Playbook. Welcome to Options Guy TV. We're right in the heart of the earnings season. We have over 30% of the companies in the S&P 500 index that are going to be announcing earnings this week. And most importantly, we've had a lot of the magnificent seven that have reported this week. And we're going to have more next week. The big one is Amazon next week on Thursday. We'll probably look at a trade in Amazon going into that earnings report. But right now we see the markets are selling off a little bit, even though we've got some good numbers from a lot of the big companies. S&P 500 index is down about 0.3%. Looking at 14 points on the downside. We had a decent run up yesterday, and that was good for our trade, but now we've given it all back. We see the NASDAQ down almost 1% at this point in time. And we have the Russell 2000 leading the way. We're a little bit up on the Russell 2000 index, which is always a good sign to see the small cap companies leading the markets a little bit higher in that instance. VIX right now is at 1395, and it's hanging around. I would expect it to be a little bit higher. We got the Fed meeting today. It's highly anticipated that they're going to raise interest rates by a quarter of a point. And because of that meeting, we're going to look at some adjustments on Monday's paper trades. So we decided that we were going to kind of have a theme of the week as far as Options Guide TV is concerned, as far as a strategy is concerned. So last week, we looked at a long call spread in the SPX. This week, I wanted to compare a long call spread with a long call. So I'm going to look at an adjustment in the long call because of what's happening and because the timing of the trade. We always do Options Guy TV at 11 o'clock Eastern time. Markets are rocking and rolling. We're using real live numbers. And there's not always a great time. That's not always the perfect time to make an adjustment on that trade. Like yesterday, I might have sold out of my long call option. But one thing about Options Guy TV is it's really about learning. So the best thing that you can get is to use live markets and do an adjustment on a trade. A lot of people know what to do when the market goes up or goes in the direction that they want it to. In options, obviously, you can be bearish in the market pretty easily also. But what do we do when the market goes against us, when it's not doing exactly what we were anticipating? And that's what today's show is going to be about, especially on our long call trade. So we're going to stick with our theme of long call spreads, and then we're going to look at what's going on in oil. Oil has the chart of oil has been interesting, just the actual price of a barrel of oil. And XOM, ExxonMobil, is going to be announcing earnings on Friday before the open. So we'll look at a trade. Now, I would say that we would normally do that trade on Thursday if we're just doing it around earnings. But we're going to look at a long call spread in ExxonMobil, and that's going to be our paper trade for the Wednesday show. So a lot going on. If I go over to my watch list, I made a watch list of companies that were announcing earnings. And we do see a lot of red here, but I feel like these are a lot of companies that are, just selling off after the earnings report. Microsoft is a great example of that. Nothing really bad in their earnings report, but it's just made such a strong move in the short term that I think people are just taking an opportunity to sell off. I talked about Snap on Monday. Snap isn't an interesting company to me. I think they have a lot of struggles ahead of them. Basically, Meta and Google are killing them as far as ad revenue is concerned. Google announced earnings. They're up strong. Google has some room to run. They're at a much lower valuation compared to a counterpart like Microsoft. AI is coming. A lot of people are saying that with Google, they know that ultimately they're going to come out with something good that's going to compete strongly with anything that Microsoft is doing. And I think that came through on their earnings report. Google is not very good at being transparent. They don't try to drive their stock price with their comments on earnings reports. But I think this time around, some people saw some good. We see that it's up about 6% on $129 stock. So Google's just been strong. As a matter of fact, I heard today that Google for the year is actually up higher than Microsoft is. So this run up and drop in Microsoft makes Google actually a bigger winner. And a lot of people, I think, it's done it very quietly. So interesting what's going on with Google and Microsoft, and it all centers around AI. Also had Visa. Visa came out and announced they're down a little bit, kind of like MasterCard a little bit more, but MasterCard, I think, is announcing on Thursday. I don't have that, but they're announcing this week too. And then I don't have the exact date. Cleveland Cliffs came out with really good numbers, real good report, and the stock's down 4%. I don't understand that one. Infrastructure, just a lot of things going on in that space, but they just can't seem to get any traction. So I guess that sums up a lot of what we're seeing as far as advertising is concerned. Snap, I think you're going to see some huge short interest in there. They just got a lot of struggles that they got to deal with, and their main point of revenue is ads, ad sales, and Google and Meta are just killing it, especially with what Meta has done recently. The stock has been amazing. What Meta has done, it took a huge downfall, but stock came roaring all the way back. Okay, so SPX on Monday's call, we had the SPX because I struggled a lot with where the SPX was at. It was at, according to my screenshot that I took at that second, it was 45.55 that I did on that day on that screenshot. And we went out and we sold the 45.45. Well, we bought the 45.45 call and sold the 45.50 call. All right, so that just made for a lot of words when we were trying to get through that trade. So now it's at 45.53, and let's take a quick peek at how our long call spread is doing. So we haven't had much movement at all in the SPX, and to put our call spread in, once again, we see on the options grid here on the TradeHawk software, we got implied volatility, delta, ask, and bid on the call side. So if we go to the 45.45, we click on the ask, that puts it down below. 45.50, we click on the bid, that puts it down below, and we're up a dime. So the market hasn't moved much. We haven't got a lot as far as time decay is concerned on our more at the money option contract. We talked a lot about extrinsic or time value on our last call on Monday, or I should say on our last Options Guide TV episode on Monday. And so the market it's not hurting us. It's not going anywhere. I'm not going to do anything with this trade. But if we go and look at the 46.05 trade, so we compared that to just buying a call outright. Now that trade is just getting cremated, 46.05. We have the Fed speaking today. I'm a little nervous about what has happened with that trade because we're on the July 28th, 2 days. I just want to make sure that I'm on the right one. 2 days away, which is July 28th, right? So 46.05, this was a $9 option contract. So the time decay and implied volatility crunch, I guess you could say, is really killing us on this option contract, buying that call option outright. That wasn't our official paper trade. We were looking at the long call spread and kind of doing a rinse and repeat of what we did the week previous. But we got to do something with this. Like I said yesterday, if I would have got the run up that we did yesterday, we had a solid move in the markets to the upside. I would have just got out of the trade, mainly because you're on an out of the money option contract and you're nervous about exactly this, the time premium that you bought and in a crunch and implied volatility going into the Fed meeting. So usually the VIX will come off a little bit after the Fed speaks today. Most of the time, obviously, it depends a lot on what they say. If they decide to raise interest rates a 0.5% as opposed to a quarter, well, I guarantee the VIX is going to stay at 14. It's going to skyrocket. Markets are going to tank hard. In that instance, they're anticipated that they're going to raise a quarter of a point, and it's all about what they say afterwards. It's all about the feeling. if Powell touches his nose when he says raise interest rates, that might affect the market. So that's a big deal. All right. So what do we do with this trade? So let's get rid of this. We have 2 days remaining. We're going to 46.05. I make sure that's right. Yep. And it was 9:40 according to my screenshot. So I'm going to click on that. And we are now trading at 570 at the mid. Now I'm going to scroll down a little bit here. And if I were to do this trade, we've lost half of our value. And I was in a long call spread. I would, even if I missed it yesterday, which I would have wanted to close it out yesterday, without a doubt. At the end of the day, I would have wanted to close it. Now I would just get out of it. A lot of times I've lost half my value. The market isn't with me here. I'd close out that trade. But here's a potential hedge that you can do. And to me, it's fairly important that you understand that if you're doing this hedge, I'm doing it because I don't want the cheese anymore. Just let me out of the trap. All right. So I could sell this for 580 and be out of the, or 570 and be out of the trade, be done. Or I could roll this into a long call spread. And then I still have a chip in a chair. I'll take some of the money off the table and leave myself with the potential after the Fed speaks to actually even make some money on the trade. So you have to decide on this one what you'd want to do. All right. So if I sell the 46.10, that's within a 1 standard deviation move. Remember, inside of the chains here on our shading, we can say 1 standard deviation move. That means that's the market thinks that the underlying could potentially get to that level. You go more than 1 standard deviation move, it's really hard for the market to accomplish that over that time period. At least the math says that. That's the way the math works. So I could sell this, bring in $5, and then all of a sudden my $9.40 cost basis, or $940, is going to go down by $500. And in that instance, then I'm going to have $440 worth of risk on that trade. So that's one way I could do it. But then I max out at $10 or at $5, right? So I cannot make anything on the trade if I do this one, in that all I'm going to make is, if I was correct and my adjustment takes that money off the table, the width of the spread is 5 points. So that's the maximum I can make. If you do the math on that, I have a $4.40 cost basis. I could make $5 on my spread. Guess what? I'm at $9.40. So in that instance, I'm just right back. Basically, once again, I don't want the cheese anymore. Just let me out of the trap. So what I would do personally is give myself a little bit of room to run. I could sell this for $5. Obviously, I'd rather, well, I'm looking at the ask of $4.90, but $4.90 would be the bid if I sold it on the bid. I could obviously bring that in. I'd rather sell something for $4.90 than $4.10 if I could, but I'm going to sell that $4.10. So this is going to be our adjustment. We are long the 46.05 call. The market has turned and gone against us. So we are now going to go in and sell the 46.15, roll that into a long call spread, and we're going to bring in that $4.10. We're still going to pay a lot for that spread, but now the maximum we can make is $10. You take $4.10 off of our $9.40, so $9.40 minus $4.10. Our cost basis is now $5.30. That's simple. And would I adjust it again? No. At this point, you can get so convoluted with these trades. And I've had a lot of people like come to me and buy a long call, and they paid $10 for it. It's trading for 50 cents. And they're like, well, how can I adjust this? I'm like, well, you just drove your car off a cliff and asked me to repair it. It's not repairable. It's done. You got to move on. And so, especially when I'm doing shorter term trades, I really don't want to over adjust the position. I usually know that I got one adjustment that I'm willing to make, and this is my one adjustment on this long call, and then I'm going to move on from there. And it's just that simple. Okay, so we're doing pretty well. If you have any questions about these trades, please put them in the comment section. I'm happy. This is a very interactive show, and I'm very happy to answer any questions that you may have. But the theme, once again, is long call spreads. So I'm going to look at ExxonMobil. I find the chart in the USO or in oil in general to be fairly interesting, right? If I look at just crude oil, a barrel of crude, I always find the $80 level just to seem to be a magic level as far as a barrel of oil is concerned. Years ago, I used to always trade the bounce off of the $80 a barrel. It feels like the economies of scale like $80 a barrel, and a lot of times it's going to move, break out to the upside or break out to the downside. Right now we see it's down 35 cents today on the Mercantile Exchange. The crude oil futures, it's trading at 79.28. Here's the USO, which tracks oil. This is one way that you can play oil. I'm sure a lot of people have heard of the USO. And we see the 200-day moving average. And we talked a lot about the moving averages. And one of the things that I find interesting about this chart is that we had a breakout and a fail, breakout on the 200-day moving average. And now this is the third time that we're breaking out. And a lot of times, once you see that, and we're right around that 80 level, I think we might be able to do it in the USO. In other words, I think we might break above that 80 level. And I do think that we could have, considering where the barrel of oil has been on ExxonMobil and some of the energy companies, I do feel like we could be a little bit bullish on it. Now, it's earnings, so I'm a little nervous. So I'm going to protect myself by doing the long call spread. But I do like what I'm seeing here in the USO, especially if we can break out above this last high. If we can continue on up, I just think that I like the way the chart looks. It's that simple. Okay, so let's go back to trading. And once again, nothing's meant to be a recommendation here on Options Guide TV. We're really just trying to learn. Like we did a lot of talking about how we would adjust our long call in the SPX. So now let's pull up ExxonMobil. XOM is the symbol. They're announcing Friday morning before the open. So I'm going to emphasize again that I would probably look at this trade on tomorrow. I would see what happens with the market. There's not a lot going on right now. We're trading right around that 105 level. What we're going to do here is we're going to straddle the market, though. So in this instance, let me go and grab, let's change the grid format. Okay, in and out. There we go. All right, so if we do the in and out chain, which I quickly changed inside the TradeHawk software, we will see the extrinsic value of the option contracts that we're trading. We went into great detail on this on Monday's Option Guide TV show. So we're going to try to buy about the same amount of time premium as we're selling. The options are fairly inexpensive, are fairly inexpensive overall. So I would not mind just buying an option outright in XOM. I'm also highlighting that implied volatility is fairly elevated, like it usually is around earnings. We're at about a 38% implied on the July 28th expiration, and we're going to trade these 2-day options. That's all that we're going to trade. And our historical volatility is around 27%. If I were to buy an option outright, I'd probably go out and look at a 16-day option, mainly because they're fairly inexpensive. Just overall, the 108 strike is trading for 31 cents. So I would consider going out further in time. But we're going to do a spread, so I don't mind. We're going to make this a 1-day just fun trade, and we'll know a lot about it by the time Option Guide TV kicks off at 11 o'clock. All right, so here's our trade. This will be our paper trade for this week. I got to clear out that trade. So we're going to buy extrinsic value. So this option's trading for 340 on the ask, 325 on the bid. Extrinsic value is 39 cents. And just to kind of show you, so sometimes if you don't have this in your chain, if it doesn't work out for you, a quick and dirty solution is to just look at what the put is trading for. So the put will show you the time value in an in-the-money call. It's just fact of life. It's not always 100% accurate, but it's close enough. And it's not a perfect scenario whenever we're trying to put these together. We want to get things, as far as time value is concerned, we want to be fairly close, right? Okay, so I see that extrinsic value is 37 cents. I'm literally just going to go down and find something that's trading for right around 37 cents on the out of the money option contract. And this is what we talked about on Monday's show, is that if you're usually equidistant in and out of the money around the at the money strike, which we're right at 105. So here's a perfect example with a live market. You see that even though this is trading for $3.40 on the ask, we still have just about the same amount of time premium in that option contract. We have $2.92 of intrinsic, 41 cents of time, as we do when we look at the 108 option contract, right? The 108 option contract is 33 by 30. The extrinsic value, they say, is usually the midpoint. So right now they're putting it right at 30. So here's the trade. We're going to buy the 102 and sell the 108. We are totally taking time premium out of this trade. We have 6 points. And what I would expect, and this is just simple math, if you go equidistant down and equidistant up around an at the money option contract, you would expect to put 50% of the width of the spread. So $6 spread, I would expect to pay $3. Look at the midpoint, 302. That simple. Sometimes the stuff is easy in the options trading world. The math makes sense. And that's one of the things that I love about the options marketplace, is that even though there's a lot of things that are confusing, this just makes sense. It's a 50-50 bet. Either I'm going to lose my $3 or I'm going to make my $3, right? If the one standard deviation move, the one thing that I do like about this is even with that higher implied volatility, another thing that we're showing you is we're shading the potential one standard deviation move in ExxonMobil. If you want to be a little bit more into it, you can look at, well, if I paid the ask here, that's 128. So 128 plus the ask over here is 126. That is the expected move, which is $2.54. It's always a little bit less than the one standard deviation move, which is right around $3. Okay. So we know that the stock has, according to the math of the marketplace, the potential to get to 108. But we also know that it has the potential to go down below 102. So we're straddling the one standard deviation move, which the TradeHawk software makes very simple to do. We are buying about as much time premium as we're selling, which also means that if the market just stays where it's at, we should be able to get out at break even. We're probably going to trade this thing on Monday's show or on Friday's show, 11 o'clock Eastern time. We're probably going to be trading. We'll look at how the trade's doing. I'd normally be out of this trade around 10 or 11 o'clock during the day, depending on obviously where the market's at. If it's blowing out one way or the other, then that always changes what could happen. But with that said, we'll be here on Friday. They're going to announce Friday morning. We're going to look at this trade. It just makes it fun to get that completion all the way through. So here's the paper trade. 302 is the midpoint. When we put it on, that we'll make that our paper trade value. We're paying $3 on a 6-point wide spread, which means that we're doing $3. Let's just make it $3. How about that? That would be a really good fill. The bid is $293. The ask is $310. $3. So now that's our price. We're willing to pay $3 on a 6-point wide spread. So we're betting we're risking 3 to make 3 overall. Interesting trade. Any questions you have, please put them in the comment section. I'm happy to address them. Very interesting show. I love the way the SPX worked out and how it kind of highlights that we're still doing okay on our long call spread, but we're not doing okay on our long call. And if you wait one more day in the SPX and you go to Thursday, you're going to see a huge rate of time decay. So it's very important to adjust that trade on a Wednesday when it's not going with you. All right. So I see that we have a comment here. Let me put it up on the screen. Oh, it's already up on the screen. I appreciate that. Will you do a similar trade in oil or the USO? Well, yeah, the USO is. I'm not going to trade futures, right? We don't have that capability yet here with Inside Trade here to do oil futures. But USO is a viable solution. And if I look at that chart, I would be interested in here. Here's what I would like to do if I'm looking at the USO side of things is I'd like to see what happens with ExxonMobil. And there's a couple other big energy companies that have announced and will be announcing, and see if we can push it beyond this level. If we can get up above this, let's call it 72.5. I think that would kind of say that, yeah, we did have a breakout. We had a breakout and fail, a solid breakout here. I would consider looking at something in the USO, but in the USO, I'd probably just buy an out of the money call. That's how I would approach it. Or if I want to be less speculative, going in the money call. I could even consider one thing I love about the USO, I'll just pull it up, is implied volatility isn't that huge and the markets are really tight. So I do like to trade in the USO and in general. So if you look at the markets here, we got right here, we got a 7-cent market. Over here, we got about a 3-cent market, a penny wide, a couple cents wide. And those are 2 days remaining. So I would go out further in time, wait for the earnings to play out in ExxonMobil and a couple of things. You're going to get some hints, and maybe look at a 30 or a 37-day option contract, still trading at about 28% implied volatility. And look how inexpensive these options are relative to the price here. So we're at a 28% implied, and that's actually kind of high for USO. But I would be considering maybe buying an in-the-money option contract and selling an out-of-the-money shorter term against it. I wouldn't mind that at all. So yeah, USO, I'm going to give you a thumbs up if you're considering a trade, but I would wait until ExxonMobil announced their earnings. All right. Any other questions that we have? Oh, we do. All right. And here it is. If you have a long call that has dropped in price and is about to expire, would you roll it into the same strike into the future? Give it more time for it to recover. It depends on how much it has dropped in price. Once again, if I've driven the car off the cliff, I'm not going to have it towed to a repair shop, right? I am going to let that one ride and go out and find a new trade. This example that we have here, I gave you a hedge or not a hedge, an adjustment. And I like that adjustment. I don't mind that adjustment. We got the Fed coming out today. Maybe we can get a little bump from the Fed. You never know. So I prefer my adjustment, but I still have $5 in premium. I paid $9.40 for it. So yeah, I could roll out further in time. I don't mind that. The market's basically where it was. I'd probably stay at that same strike, but just give myself more time, take a little bit of a loss on the near term and give my trade more time to play out. And we even mentioned that on Monday's show that normally we would buy a more longer term option contract. But we wanted to compare what this week a long call would look like versus the long call spread. So we're going to get some news today. Markets are going to play out. We'll see how these trades do. We'll come back on Friday, and we'll have a lot to talk about on Options Guy TV. And I think that is it. I think we're all good on the questions. All right. And thank you for coming. Click subscribe, ring the bell, and we'll see you this Friday at 11 a.m. for the next edition of Options Guy TV. Thanks for coming, everyone.